To be fair, we haven't actually acted on a lot of the big stuff, which was restructuring how Harriet and I are investing and all of that, because we're still working through a few things. What we have acted on, and we want to go into detail today, is our superannuation. For Harriet, she wanted to be more involved with her super. She was just with an industry retail super fund. She wanted to be more involved, and she felt like she was a little bit behind on where she should be. And similarly, I am pretty involved with my super fund, but obviously just wanted to roll it all up into now what is Hub 24, and I guess manage it alongside you. So that's where we're at. We've both rolled over.
So let me just ask you here, are you and Harriet now, do you have the same super? Like, do you have the same investments?
No.
Okay, so
No.
because you've got a portfolio here, this is your portfolio.
This is my portfolio, yeah.
What's
yeah.
Ham? Just 100% Bitcoin.
Harriet's very similar with, so for correct me if I'm wrong, for two things, and we'll get to it in a minute. She's not as geared as I am, even though I'd like to be more geared, but that's that's maths. She's not as geared as I am. And secondly, for some of the individual stocks, there are differences as well, so that as a household unit, we're diversified. Yeah. Is that fair?
Yeah. So we take a few different approaches when we're investing for a couple at Northhaven. So for a lot of clients, we'll be fully active direct equities, right? So Bryce, I know, has a lot of history with the index and is happy to hold the index as well. So we have an allocation there, but that's not common across all of our clients. Bryce certainly isn't the only one. It's very case by case, right? So our portfolios for our clients are fully bespoke. We get to know you, your risk tolerance, and the kinds of investments you like, and we build it around that. For clients that we have fully direct or mostly direct and just some managed funds, if they're, say, a husband and a wife, or just a couple in general, basically all of those direct holdings are going to look different. And it's because we're looking at them as a household, and we're trying to diversify as much as we can across the household. With Bryce and Harriet, there's commonalities. Some of the, they both got the index in there, both got similar managed funds, but the direct stuff is all different.
All right, well, let's get into it. Don't hold us in suspense any longer. What's the portfolio?
So let's start with portfolio construction from an asset class point of view. So we've currently got cash and fixed interest at 5%, property and infrastructure at 10%, and then growth at 85%. Now, this was after a bit of back and forth with Matt, because originally I think you pitched closer to a 70-30 split.
Oh, Bryce was never going to go for
no,
that.
and I was hating that. So then I went back and said, I want 95-5.
Okay.
Well, I actually said, I think I said I want all growth. I was like, I don't understand why I understand why. I was like, I don't want cash. Yeah. None of that. Get rid of all of it. 100% equities.
So what was the argument to have 5% cash?
Well, there's a few reasons for cash. We're trying to build a well-rounded, diversified portfolio. In the wise words of Charlie Viola, we're not looking to blow up anyone's money, right? And it's all risk adjusted. So Bryce and Harriet both did risk tolerance questionnaires and things like that. That gives us an idea of where you sit on that risk scale. Bryce came out as an aggressive investor, so right at the sort of upper end of the spectrum.
Not surprising.
Yeah. So and look, it's appropriate for someone in Bryce's position and his age, and that was fine. So we have our standard asset allocation for such a client, and that would look like more sort of 10% cash and fixed interest, 15% property and infrastructure, and we consider property and infrastructure part growth because they're still equities, they're still shares in companies, but also part defensive because they have some quite defensive attributes, and then the remaining 75% across Australian and international equities. Bryce came back and he wanted a whole lot more in equities. We settled somewhere in the middle. The reason for having this 5% now to cash and fixed interest, firstly, you have to have some cash in these accounts because there's fees. Any super fund that you're with is going to keep a little bit in cash because they need to take their fees just like Hub 24 does. So there's a minimum amount of cash you have to have in there. But on top of that, we've added some exposure to bonds and other fixed income assets. The reason being they're good ammunition when you need it. It's easier to get out of a lot of these assets without tax liabilities. So if you see opportunities in equities, you have some ammunition that you can draw on to buy into the equity market. Also, just the negative correlation with equities. So it's a bit of a hedge, a bit of protection against what equities do. That doesn't always work. So 2022 was the worst year. 2022 was the worst year in history for bonds in a couple of hundred years. And equities had a pretty tough year as well. So sometimes they do move together, but that was quite unique with yield spiking and the impact that had on bonds. But generally, there's a negative correlation. So if equities are pulling back, then your bonds or your fixed income is hopefully holding things together for you.
So I let Matt have his fun in the 5% fixed interest. So just to break it down, there's 5 positions within this part of the portfolio. Cash at 1.5%, and then everything else is about 1%. So we've got a Global X Treasury bond, a Metrics Direct Income Fund, an Australian Composite Bond ETF, and an investment grade corporate bond ETF. I have told Matt that his benchmark for the 12 months is DHHF. So
across the whole portfolio.
Across the whole portfolio.
Okay, yeah.
So for the end of 12 months,
Not
I don't think I've told you that actually, but GHHF, we'll go the geared.
All right, that's a challenge.
So that's fixed in. Then 10% is in property and infrastructure. So we've got the Vanguard Australian Property Securities ETF. We've got the Vanguard Global Infrastructure ETF, Transurban, Auckland International Airport, APA Group, and Region RE. The direct exposures there are all about 1%. The ETFs are between 3 and 3.5%, which gives us that 10. What was your thinking around this, Matt?
Yeah, so look, property and infrastructure, like I said before, part growth, part defensive. So it's growth because they are shares in a company. Also part defensive just in the way they operate. So they're seen as a bit of a bond proxy. So in previous years, bonds have been a little bit out of favor with yields going higher. Property and infrastructure assets are valued in a similar way, so they've been a little bit out of favor. But as yields start coming down, we expect these to start picking up again. The reason why they are quite defensive is a number of reasons, often very high yields. So APA Group in your portfolio has a yield of about 7 to 8%. And so it's generally pretty stable income. It's lower volatility due to these long contracts they have, often with government bodies. It's an inflation hedge. So Transurban, also in your portfolio, they own and operate toll roads. Most of us would have paid Transurban a few tolls. They have a lot of their revenue linked to inflation, so they can just keep bumping up their prices with inflation with a floor of 4% on some of their revenue. So regardless of what CPI does, they're just passing on all these inflationary costs. So very defensive in that sense, as well as these are essential services, right? So APA Group has gas pipelines all throughout Australia. Auckland International Airport is the largest travel hub in New Zealand. Transurban, toll roads. VAP has a large exposure to Goodman Group, so these big industrial sites and data centers. They are going to function well in any economic climate because they're essential services. So it's got that defensive aspect. So that's why that's in there.
So with these particular shares, Transurban, Auckland International, and the like, how are you thinking about like holding times for them? Do you think about some of these like longer term bond proxy stocks the same as some of these ETFs and funds?
Not necessarily. So these are all fairly opportunistic buys based on what the price has done recently. So as I said, they've been a bit out of favor with yields higher. We expect that to turn. We, perhaps would have been more flexible around the asset allocation in previous years, just given what they were doing when they were at highs and weren't looking as attractive. But now it might take a year, it might take 2 or 3 years to play out, but we think now's a good time to be in there. So it's more opportunistic.
Nice.
All right, so then the growth part of the portfolio, which is 85% of the portfolio, and this is where I was knowing, having had experience with a lot of the core index ETFs, I wasn't keen or didn't see the need to have everything in just direct stocks. So to break that down, my Australian exposure is between 2. We've got the A200 and the Gear portfolio ETFs. US, we've got IVV and the geared GGUS. We've got Europe, VEU. Then we go into a bunch of managed funds. So we've got Munro's Global Growth and Hyperion's Australian Growth. On the small cap side, we've got Munro's Small and Mid Fund. And then for emerging markets, we've got Pengana Emerging Companies, Spheria Emerging Companies, and the Plato Global Alpha Fund. So that kind of makes up the core. Then we go into some thematic ETFs. We've got Semi, Hack, and Robo, all of which I think would be very well known amongst the Equity Mates community. We also have in there a banks ETF. And I think that's it for ETFs. And then we go into a bunch of individual stocks. So we've got Gold, Newmont, we've got James Hardie, Google, Microsoft, Block, Lockheed Martin, Disney, Transmedics, Chipotle, and Costco. Now, I read it in kind of weighting order. So the most weighting is up in the index, with most of the individual stocks not going over 1.2 to 1.5% of the portfolio. I think just to put some context to how this is different to my original super portfolio, I didn't have any individual stocks in my original super portfolio. I just had a shitload of of American tech and gearing, which was doing well.
It was.
As much as I could get because it was limited in Superhero. And I didn't have any of the managed funds. I know Ren was keen on some of those managed funds, so that was good to see. And I did have some of those thematics. I had Semi and things like Fang Plus and bits and pieces. The biggest change here is obviously a much more structured portfolio construction, because I didn't have that sort of lens on it, and many, many more positions.
Now, Bryce, when you read through that list, one thing I did think was not a lot of specific Asian exposure. I'm sure there's some in the managed funds. But VEU, you mentioned, it's not just Europe, it's all world ex-US. So it's Europe and Asia.
Yes,
correct.
Yes.
Yep.
So that's kind of your core, America, Australia, and then VEU is kind of rest of the world ex-US.
Yeah.
And then everything else is your satellite.
Yeah.
Is that? Yeah.
Yes. Yeah.
That's it. Yep.
So one question I wanted to, briefly discuss, Matt, because it could go down a rabbit hole, but was just around your process for manager selection, because we've got a number of managers in here, of which Alec and I are aware of and fans of. But if you were to put this in front of someone who had no idea, how do you go about selecting Munro, Hyperion, Pengana? What's your thinking?
Well, actually, sorry. Before you even answer that question, because when Bryce was reading that list, I clocked that these are a lot of managers we've had on the show and that we think do a good job. Did you have any input on the managers?
No.
So this was all Matt. Yeah. Okay, that's interesting.
Yeah.
So it means we have somewhat of good judgment of people that come through.
Yeah, I did read. I did look
If
at
you trust
this
our
when you put it
judgment.
through, and I was like, you know what, we're on the right track.
Okay. So to that question, how do you end up with these managers?
Yeah, so these managers, this has been years of meeting with fund managers. So even straight after this, we're going to meeting with some fund managers. So getting to know them, seeing them present, having that more personal level, so they're not just a name behind a screen. It's also been years of the guys at Northhaven, our investment committee, researching these particular fund managers. That means looking at fees, looking at performance, just checking that their whole investment philosophy aligns with ours. And these are the names that we've come across over and over again that have sort of pointed to these are some of the best in the business. They outperform and we like their style. And that's what it comes down to. So a lot of our clients will hold these similar fund managers because we really back them.
So similar question from me around that I asked earlier around the individual stocks. There's a list of names there: Aussie stocks, US stocks, some big, some nothing too small, some sort of medium size, I guess you'd say. How active do you plan to be in this individual stock part of the portfolio?
Yeah, fairly active. Again, this is all opportunistic buying. We've seen these at what we consider either good prices, or admittedly some of them are expensive, but it's because we see good future, good growth for a lot of these names. But we don't buy and hold forever. So we are long with our equities, but we take profits, we trim and we reallocate that. Part of that is keeping this asset allocation in place as part of good portfolio management, making sure we keep that structure. But also we just don't want to let something run forever when an opportunity is presenting itself elsewhere.
And so is that you're doing that work, or is there an investment committee and like model portfactors in the background, or are you
none of that.
Prices super all the time?
Yes, yeah. So for all of my clients who I'm managing money for, I'm actively watching this, keeping up to date with what each company is doing, and taking a very active approach. Now, we're not equity analysts or anything like that. We do rely on various sources of information and news to understand these companies and financial reports and so forth. But we might not be equity analysts, but we certainly back ourselves as portfolio managers, and we have a long history of doing that. So yeah, active in this space, but I wouldn't make a substantial change without talking to Bryce first, right? So this is all run under a managed discretionary account, which means I can actually do basically anything I want with this. Bryce has signed off and said, manage it as you see fit.
Yeah.
But
That won't happen.
But Bryce can leave you at any time. So
he can. He's not locked in forever.
Yeah,
when he wants to go elsewhere, he can. You better not, but he can. So, yeah, but any significant change, I would be on the phone with Bryce and say, this is what I'm thinking. This is why I'm thinking it. Should we make this change? What are your thoughts? Or do you see opportunities elsewhere? So he has a lot of input and flexibility around this as well.
Maybe,
I
maybe
think
don't ask him what he sees.
I mean, James Hardy's a good example. When the news came out and the stock plunged 20%, Matt was on the phone. Don't panic. This is why, kind of thing. This is our thoughts. What do you want to do? Kind of thing. So I think just to sort of close it out, the strategy going forward. Obviously, there's going to be regular contributions. We can't split it, or we won't be splitting it amongst every single position in the portfolio every time the money goes in. So we'll kind of weight it towards the core, have a bit of cash on the side so that when opportunities come up for me on the show, or I want to be active, or if Matt and the team find that there's changes that need to be made, we'll have some dry powder on the side as well. And that it'll just be an ongoing process now.
Yeah.
Love it. Well, that was really interesting. I think it'll be interesting to keep tracking your journey. Matt, I think Alice and I will probably come and chat to you soon, so we can have a similar conversation. But if you want to speak to Matt or any of our hand-picked advisors here at Equity Mates, head to equitymates.com/advice. Fill out the form. Let us know a little bit about who you are, and we'll match you with an advisor that we think fits your circumstances and your needs. Or if you just want to speak to Matt and you want to skip most of the form, there's a drop down where you can choose Matt or anyone's name, and we'll just put you in touch directly. But Matt?
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.